Let us see the loss events little detail. Legal liability happens when the judgments go against the bank, and there is a lot of legal expenses the bank has to incur if it has to contest in the court. And the regulatory action, nowadays the regulators are very stringent about the regulation part. It's the phenomenon worldwide, and the regulators have started putting the financial penalties. And in the extreme case, even the bank, the bank license given to the banks also can be invoked. And loss of damage to the physical assets is a direct loss to the bank. Restitution, and basically a payment to the third parties on account of operational losses for which the bank was legally responsible. This basically happens in case of a fraud, employee fraud, and the bank has to replace funds in the customer's accounts in the first place. So it amounts to operational risk loss. Loss of recourse is in case you incorrectly transferred the funds from the customer account, and you are not able to get back the funds, because particularly this happens in international payment systems. Suppose you wrongly mention either a SWIFT address or incorrect account details. Probably the money will end up in the wrong account, and it's very difficult to retract the money which is wrongly paid. So in such circumstances, the bank has to make good the customer the amount. And the write down is basically the when you direct reduction in the value of asset due to theft or fraud, like cash losses up from the vault if you are losing part of it. So it's a straight away write down on the assets. So these are the effects basically of the different OR events which we have discussed, basically come out of 4 causes. Now the approach, Basel approach for the, we have discussed earlier that there is a capital charge from Basel II. Basically there are 3 methodologies which are prescribed by the regulators for computation of capital charge in the banking sector. And they are basically the basic indicator approach, which very primitive, which just doesn't consider different activities risk-wise, but it says all banking activity has a similar kind of risk, and charge flat 50%, 15% on the gross income. And the second approach is the standardized approach, basically which do recognize the different business activities. Business lines are, risk-wise are different, so have different beta factors. So instead of 15%, it is 12, 15, and 18%, again on the gross income. Really the advanced measurement approach, which really is the one which will put the operational risk controls in place, because the banks also will find a lot of incentive for migrating to this kind of an approach, because it basically talks about addressing different business lines and also the loss events in each of these business lines. So basically you end up with 8x7 matrix, and each cell represents a kind of a loss event, and the banks have to categorize, identify those losses in these different kinds. And basically it requires intensive data. You need to have internal loss data, historical internal loss data, and wherever you are not in that kind of an activity, probably you can rely on the external loss data from the banks or organizations which are in a similar business. And wherever you don't have an history either from the internal data or the external data, you have to go for scenario analysis. Basically it's an exercise using the experts and creating some scenarios wherein there is a possible event which can impose operational risk loss to the bank. And the mitigant under the advanced management approach, of course, you can use maximum 20% of the capital charge by having insurance. Now it is said that operational risk of all the 3 risks is the most difficult one to quantify. So when it comes to quantification, so if you say that the quantification is possible by saying that you categorize that as a science, the market risk by far the most quantifiable kind of a risk, because there are different methodologies basically have a reliable publicly available historical data about the price movements and the historical events. So it is, in case of a market risk, it is the 90% it's a science and 10% is art. But you come to the extreme case of operational risk, which is basically still has remained primarily an art, because it's very difficult to have a model which can predict the operational risk events, because they themselves are unique, and it's not generally the kind of events you have seen are of their unique on their own. So it's very difficult for any model to predict exactly the kind of losses in the operational area. So its science is very less, 20%, and it's more of an art. Now, the operation management framework, broadly it starts with the very good corporate governance at the top, board of directors setting up the guidance and approving the operational risk management framework, and the top management really converting this operational risk framework into policies, procedures, and processes for implementation, and then setting up the independent operational risk management team. And then the identification and assessment is based on the process activity maps. Basically, each process has to be mapped. And then the loss data collection becomes a very, very important requirement for operational risk management. And then quantification based on the historical loss data. And wherever you don't have the loss data, you have to rely on the scenario analysis to build up those missing cells which are seen in the 8x7 matrix. Then monitoring is through proper monitoring of key risk indicators, and then periodically redoing this risk and control self-assessment. And timely, accurate, relevant, and periodic MIS and other reporting becomes very, very important. Then the one of the important requirement for the success of the operational risk management is basically the education and communication workshop throughout the organization. This is very important. You need to create awareness about the operational risk impact amongst the people who are on the operational level. Controls and mitigation, having set up the policies, it's very necessary to have internal control policies through proper controls, audit procedures, and also to evaluate kind of the the mitigations which have been set up, whether they are working, whether there is a need to revisit, reevaluate them. So the framework in the organization, on top the board of directors, then the risk management committee of the board basically is a subcommittee of the board, and then operational risk management committee, basically a set of senior functioning executives like general managers, DGMs of the bank, who from different drawn from different business lines, whether it is a control function or it's a business loan or deposits or other kind of operations like audit. These people will go through all the policies which are any product being a new product being introduced in the bank will go through the operational risk management committee, and for their approval that the product doesn't pose any additional operational risk to the bank. And operational risk management specialists basically are drawn. They are basically the experts who are from different business lines. These are the people who actually know the ground reality in all the operations, and they basically are responsible for setting up proper controls and see whatever the policies which are framed will take care of the really the control function at the grassroots level. Then of course the operational risk management department basically acts as a convener for the operational risk management committee to set up the meetings and wherever required to conduct kind of RCSA exercise, setting up the KRIs. And when you have a large, widely spread out network, we need to have risk management set up even at the controlling offices, because operational risk is something which needs to be managed right from the grassroots level. So it's very necessary that somebody very close to the operations monitors your operational risk. And again at the branch level also, wherever you have the business line. So that is the first line of defense. The business people are the first line of defense against any operational risk events. So they need to be involved. We said earlier that operational risk is more of an art. So though it is an art, but you cannot leave everything to the imagination of the people. So what makes the operational risk more difficult is to sort of the intensive kind of a loss data collection. So the best kind of a input for any kind of analysis of an operational risk management program in the bank is about collecting the loss data. So it will provide its own, it's the bank's own events. It's the bank. It has, it's bank's own history. That bank has faced so many events, and that is the kind of loss, and it is real. So bank need to undertake the loss data collection exercise on a regular basis. This is very, very important. And then we need to analyze and find out, along different business line, which is the area where these losses are incurring, and what are the kind of, causes. That is also important to know. Once having known the losses, we have to further analyze what are the causes, whether it's on account of a failed system or the people or, external event. That's very, very important. So for all this, you need to have a what is known as a loss data reporting template. This is very important. It has to be, the all lost events have to be reported where it has happened. So probably, the originating place from where all this data has to be reported. And it's very important for somebody in the controlling office to, track these incidents online. So what it says is basically you have to report to the extent possible immediately once the operational risk event has, loss event has happened, using what is known as LDRT, loss data reporting template, and somebody need to analyze on a real-time basis. So we have seen that in the advanced measurement approach, you need to identify the losses across the business lines and according to the loss event type. So this becomes very important, that whenever you have an event, loss event, it needs to be put in that 8x7 matrix, so that this gives a proper, exactly we know the business line and the kind of loss event where the loss has actually happened. And when you put them in this matrix, it gives a further insight into the kind of operational risk losses the bank is incurring, because you are pinpointing exactly where the losses are happening, and you will always be able to analyze, and you will be able to find out which event have most impact, because it's not the loss event per se which is very, very important. We also have impact. So because it's not like any other credit risk where you know that when some account becomes NPA, we know that exactly what is the amount of loss we are going to incur. But operational risk is quietly a bit different. So so we need to track them, and also when we track, we know that which are the business lines which are susceptible to operational risk. When you collect this data online, you will be able to analyze that better. So basically these are the business line and event type metrics. So we know that there are 8 business lines which are used in the standardized approach with different beta factors. Corporate finance, trading and sales, and payment and settlements having a highest beta factor of 18% compared to the uniform 15% alpha factor in case of basic indicator approach. And the event types we have already discussed: internal fraud, external fraud, employment practices, workplace safety, client process and business processes, damage to physical asset, business, the system failures, business disruptions and system failures, and execution, delivery and process management. So when you categorize each of the events into exactly the business line and according to the event type, probably you will have all the data in this 8x7 matrix. And when you are found the operational risk losses, it's very important. Like I said, the frequency is just not is very important. What is important is the impact. So if you can put them in the matrix of the impact versus frequency, you will find there are four quadrants in this. One is the low impact and low frequency. So we can say that these are the kind of events probably doesn't matter much, because the frequency is also low and the impact is also low, and operational risk need not worry. The operational risk management need not worry much about this kind of events. What is also not relevant is high frequency, high impact events, because what it says is if the organization is having high frequency, high impact events, probably the organization will not survive. So probably these are the things which may not be very relevant in the sense a running organization need not focus much on this. And what really is important is high frequency, low impact events, which like minor accounting errors, leakage of income, routine mistakes, normally which we find as an observations or in the audit findings. We will find that revenue leakages, some small documentation errors which can be corrected. Those things can come under high frequency, low impact. And high impact, low frequency, or the events are few, but at the same time it have a catastrophic impact on the organization, such as fire, flood, earthquake, terrorist attacks, etc. And some of them can be mitigated, by having a proper insurance and all. Now, as a operational risk identification, the first step is risk and control self-assessment. This is a very important step in the operational risk management. Basically, it involves listing out all the activities across all the business lines, and then going through all the processes when you want to complete. Say if you are talking about a loan sanction, you start with accepting the loan application, and then how it is processed, how it is documents are taken, who authorizes the loans, and then ultimately how the loan is dispersed and who ensures the end use of funds, and right up to a proper recovery of the loan, satisfactory recovery of the loan. All this is a process as far as the loan product is concerned. So what is required is the experts from this field will sit together and identify the kind of possible events in each of the stages in these processes. This will help in at the same time they will also identify the kind of the controls, mitigant which can be put in place. So we can use the experience, judgment and intuition, and historically we also know that a particular kind of an activity is exposed to kind of an operational risk event, which probably will result in we will be able to some sort of a quantification of the kind of operational risk losses on account of a particular error in a particular process. The key risk indicators are basically they are the early warning signals. They probably are earning of future losses. What is that which will bring in operational risk, or what is that which increases the operational risk in a particular thing. If you are aggressively lending, and if there is a very fast employee turnover, and if there are a lot of system failures in the past, and so these are some of the indicators which will tell yes that probably the bank is heading towards a operational risk loss in a particular area. So these key risk indicators are very important, and they come out of when you complete your RCSA exercise. So when you are doing a risk and control self-assessment, probably you will come across different kind of processes, and where there is a possibility of the person making a mistake or the system going wrong. Risk and control self-assessment process, when you do it very systematically, it will help you to design of appropriate key risk indicators for different processes across the business lines. So it's very important that the RCSA exercise is done, and it's done periodically, and it's done for all the new products or for all the existing products whenever there is a change in the process also. And we can put a threshold to link to the indicators, saying that how that key risk indicator, whether it is to be treated as high, medium, low, depending on the impact it has or the process to which it is related. And we know that the key risk indicators are forward looking. So when you are framing the key risk indicators, we have to base your the judgment based on the what is the kind of volumes, what are the kinds of products, or what are the kind of processes the bank is going to follow in the coming years. So it's more of a forward-looking exercise.